We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets.
Markets ripped higher to start 2026 as investors shrugged off weak U.S. jobs data and went all in on central bank easing, triggering a violent rotation into U.S. small caps and European equities. Inflation victory laps in the U.S. and Europe fueled risk-taking, even as manufacturing slumped and the labor market cooled. Meanwhile, Asia pulled the other way. Japan rallied on a collapsing yen despite falling real wages, while China's AI-fueled equity surge ran headlong into entrenched deflation. One world easing, one world stagnating, and that global asymmetry is now driving every asset class.
Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
We are back, and wow, what a way to kick off the year.
It really was something.
I mean, 2026 didn't just start, it sort of. It exploded. It feels like the entire narrative from the end of last year was just instantly reset.
Instantly. And that's the bizarre part, right? Investors just collectively decided to shrug off some really soft U.S. jobs data.
And all the geopolitical noise just ignored.
And that collective shrug, that's really the central tension we have to explore this week. It feels less like pure confidence and more like an aggressive bet on central bank support.
So it wasn't the usual mega caps leading the charge?
Not at all. And that was the big surprise on the street. It was small cap U.S. stocks and, European equities that were really out in front. It's a bet on resilient earnings and, most importantly, that easing cycles from the Fed and ECB are coming.
It feels like the script is completely flipped in just 1 week, and it just exposes this massive paradox that's defining the world right now.
It really does.
On one side, you have the West, sort of celebrating what looks like a genuine victory over inflation. Prices are cooling.
And central banks might ease.
Exactly. But then on the other side, you've got Asia wrestling with this deep, stubborn anchor of deflation, especially in China, and then those weird wage dynamics in Japan.
And that asymmetry, that global tug of war.
Yeah.
That is the lens you need to view every single asset class through right now.
So that's our mission for this deep dive. We're getting into the regional specifics, why it all matters for your portfolio, and then we're delivering the 5 critical risks you need to be watching next week.
Let's do it.
Okay, let's unpack the biggest puzzle of the week first. The U.S. markets. I mean, the headline numbers were just massive. The S&P 500 up 1.76%, NASDAQ up 1.85%.
And the Dow Jones pushing past 3%.
It just suggests this broad, hard-charging optimism.
The headlines are strong, for sure, but the real structural shift is happening further down the food chain. You have to look at the Russell 2000 small cap index. It surged an unbelievable 5.73%.
In 5 days.
In 5 days. And this is building on a rally that's seen those smaller names climb almost 14% over the last 6 weeks. That is a massive, aggressive move into high-risk assets.
That surge in the smaller names is so crucial, isn't it? It suggests participation is finally broadening out.
It is. We saw the equal-weighted S&P 500 actually outcase the cap-weighted version.
Which tells you it wasn't just Apple and Microsoft dragging everything up. It was investors spreading their capital around aggressively.
Precisely. They're chasing the beaten-down names that got crushed by high rates. But, and this is the key, this aggressive risk-taking is happening despite a labor market reality check that should have given everyone pause.
Right. The headline non-farm payrolls number.
It came in at only 50,000 in December. A complete miss.
And it wasn't just the weak December number. The revisions were, they were brutal.
76,000.
A combined 76,000 jobs from October and November just gone, wiped from the books. And we saw softness from ADP, from the JOLT test data.
It's clear. The labor market's cooling, and maybe faster than the Fed was thinking.
And this is where that economic divergence comes in. The job market cools, but the economy itself seems to be splitting in two.
A complete split. You have manufacturing, the ISM PMI at 47.9. That's its 10th straight month of a contraction. a clear slump.
But services?
Services PMI surged to a 2025 high. It's all about new orders.
Yeah.
Services are basically the only thing holding the economy up right now.
And if that wasn't enough volatility, we had some serious policy whiplash this week.
Oh, yeah. Aerospace and defense stocks got hammered after that proposal to limit dividends and buybacks.
Only to rebound just as fast when a military spending boost was announced.
It's proof that volatility is just as much about perceived intervention as it is about macro. And don't forget the home builders. They were all over the place before reacting to that huge surprise $200 billion mortgage bond purchase plan.
A direct intervention.
Policy is driving sector performance. Full stop.
So with all that noise, how did the bond and commodity markets react?
Well, fixed income stayed pretty calm. Long-end Treasury yields dipped a bit, which tells you lower inflation expectations are baked in. Corporate bonds outperformed.
And metals?
Metals just continued their breakout. Gold surged above $45.20 an ounce, and silver just blew past the $80 mark.
Okay, so let's synthesize this U.S. situation. The market is rallying, especially in risky small caps, specifically because the economic data is bad.
That's the core takeaway. And it is such a dangerous game. The rally is fueled by soft data. Investors see cooling jobs as, essential fuel for a dovish Fed for rate cuts. They are betting everything on a perfect soft landing.
But where's the danger?
The danger is the mechanism itself. The market is cheering weakness, right?
Yeah.
But the depth of that manufacturing slump, the speed of the labor cooling, it all increases the risk of an overshoot. If job losses accelerate, that dovish Fed hope turns into a recession panic overnight.
And that erases the whole rally.
The market is currently celebrating its own risk.
A crucial insight. Okay, let's pivot to Europe, which also had a surprisingly strong week. Cestio XX 600 up over 2%. The German DAX up nearly 3%. Are these actual green shoots we're seeing?
The data certainly suggests momentum is building. Germany, which we know has been the laggard, saw industrial production rise 0.8% in November.
And the orders were even better.
Orders surged 5.6% month over month. That signals a real pipeline of demand is building in the region's biggest engine.
Consumers were also there. Eurozone retail sales were up. But the big headline was the inflation number. Headline CPI fell right to 2%.
Perfectly on the ECB's target.
It sounds like mission accomplished for the European Central Bank.
It was definitely marketed as a victory lap. But here's the nuance, the really critical piece that complicates everything for them. While headline inflation is contained, core CPI.
Which strips out food and energy.
Right. It only eased a little to 2.3%.
Right.
And services inflation is still stubbornly high at 3.4%.
So that's the snag. We've won the war on goods inflation, but we're still fighting the battle on services. Sticky services inflation means wage pressures haven't really gone away.
Exactly. And that raises a really important question for the ECB. I was reading a strategy note from Thomas Wieladek, and he suggested the ECB's easing cycle might already be over before it even really began.
Because of that services number.
Because of that services number. They're in a horrible spot. If they cut now, they risk reigniting wage inflation. If they wait too long, they could stall Germany's fragile recovery. It is a policy tightrope for 2026.
And just quickly, before we leave Europe, look at the UK. It's not nearly as positive, is it?
No. The UK sidebar is much weaker. Mortgage approvals dipped again. And Halifax reported a surprise 0.6% drop in December house prices. It's still a major drag over there.
So we've seen the West fighting inflation. Now we move to the other side of that global tug of war, Asia, where the fight isn't against inflation, but against deflation.
A totally different battle.
Let's start with Japan. Equities surged. Nikkei 225 up over 3%, helped by that weak yen.
Yeah, it slipped to 157.6 to the dollar. A huge boon for exporters. And the domestic economy actually showed surprising life. Household spending rose 2.9% year over year in November.
That smashed forecasts. People were expecting a decline.
They were. It was led by auto sales, a huge consumer surprise. But, and here's the contradiction.
The wage numbers.
The wage contradiction. Despite that spending surge, real wages actually dropped 2.8% year over year.
So how can spending be up if people's purchasing power is going down?
It suggests maybe some pent-up demand, but the structural pain is real, and it puts the Bank of Japan in a tough spot. Governor Ueda is signaling rate hikes are coming. But if real wages are falling, how sustainable can any inflation truly be?
Okay, now let's talk China, where the market and the economy feel like they're on different planets. Mainland stocks rallied hard, Shanghai Composite up almost 4%.
All driven by a dramatic AI frenzy.
Is it a frenzy?
It is. Turnover spiked to around 2.8 trillion yuan. Margin debt is near record highs. This is pure, unadulterated speculation. Investors are just piling into AI names.
Believing tech will be the savior.
But the reality on the ground is that the deflationary anchor is still deeply, painfully set. The Producer Price Index, PPI, fell 1.9%.
And this is the truly astonishing number.
It's the 39th straight monthly decline.
39 months, that is not a blip. That is a structural crisis of price weakness.
It is. And it means China's full-year inflation printed at a stark 0.0%, the lowest since 2009. That deep deflationary pressure makes the case for more PBOC easing. They have to stimulate.
But if they do, don't they risk just pouring gasoline on that AI fire?
They absolutely do. The PBOC has to brake and accelerate at the same time. Ease enough to fight deflation in the real economy, but not so much that they inflate a dangerous asset bubble in tech stocks. It's an incredibly difficult balancing act.
We've looked back, now let's look forward. This coming week, January 12th to the 16th, feels absolutely critical. We're moving from old news to what's going to set the agenda.
We are. And the entire market's soft landing bet really hinges on the data coming out of the U.S.
Tuesday and Wednesday.
Marquee events. Tuesday is the CPI report. This is the big risk for an inflation surprise. If that thing comes in hot, the whole dovish Fed narrative that drove this rally gets wiped out instantly.
That's the first test. And then Wednesday, it's all about the consumer. We get retail sales.
Which is the test for that consumer slowdown risk. A big miss there would confirm that the cooling job market is hitting spending, and that validates the recession fears.
And internationally.
Three big ones. Wednesday, you've got China's trade data, exports and imports, crucial for the global demand picture.
And then Thursday is Europe Day.
Right. You get the UK's monthly GDP reading, and then Germany releases its full-year 2025 GDP growth. That number will basically shape the entire narrative for the Eurozone's recovery, or lack thereof.
Okay, let's solidify this. Let's make it an actionable checklist. The 5 biggest threats or surprises you have to track this week.
This is the knowledge that keeps you ahead.
So number 1, the single most critical market-moving risk has to be that CPI print.
It is. The U.S. inflation surprise on Tuesday. Why it matters. A hot number could vaporize those dovish Fed bets. It is the most immediate threat to this rally.
And if inflation behaves, what's risk number 2?
Retail sales weakness on Wednesday. Why it matters. The market believes the consumer is resilient. A big miss here would directly challenge the entire premise of the equity surge. It proves the economy is actually shrinking, not just cooling.
Got it. Switching to Asia, what's the key signal from China?
We're watching the China trade rebound, or not. Why it matters. This data signals whether global demand is stabilizing. If exports are still sinking, that deflationary risk we talked about gets much, much deeper.
And finally, 2 markers for Europe.
Absolutely. First, track UK growth stalls.
Yeah.
Why it matters. Thursday's GDP read will be crucial. A surprise contraction would raise red flags across Europe.
And number 5?
The German economy in focus. Why it matters. Thursday's full-year GDP data for 2025 will define the story. It tells us if Europe's engine is genuinely ready for a global slowdown.
What an incredibly data-dense week. But the takeaways on market positioning are so critical. Markets kicked off 2026 with, just unbridled excitement.
Small caps surging in the U.S., that AI enthusiasm in China, headlines celebrating low inflation in Europe.
But beneath all of that, the deep structural issues are simmering. The cooling U.S. labor market, that entrenched China deflation, potential ECB limits, it's all converging.
And this week's data calendar is the pressure test for this new rally. If the data disappoints, the market's aggressive bets are going to come home to roost.
So the final provocative thought, how does that global asymmetry you mentioned at the start shape capital flows for the rest of the year?
The thought I want to leave you with is focused squarely on that. You have the West celebrating victory over inflation, while Asia is wrestling with the ghosts of deflation. What does that actually mean for global capital flows when the PBOC and the Fed have such fundamentally different jobs to do? And I'd encourage you to really think about the relationship between that persistently weak yen and the drop in Japan's real wages. Does the weak currency eventually break the consumer's back? Or is it the only thing keeping those exporters afloat? That tension is central to everything in 2026.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.